Hello and welcome. I'm Mimansa Verma and I'm here in conversation with Mr. Kapish Jain, Chief Financial Officer of IIFL Finance. Thank you for joining us, sir. So on Wednesday, IIFL Finance released quarterly earnings and reported a 25% rise in net profit after adjusting for the non-controlling interest. But if you look at the standalone number, it is a 38% year-on-year fall. So just wanted to understand why is there a disparity between both the numbers, considering digital loans, which is part of IIFL Finance's core business portfolio. The AUM of digital loans has risen 77% on year, but still there's a disparity. So if you could explain that for us, why is there a difference between both the numbers?
So, on the standalone financials, almost a large chunk of the portfolio is sold to banks under a direct assignment transaction, which results in upfronting of the income which comes into the P&L. So historically, whatever portfolio we have sold to bank has been taken as an upfront profit in those periods when they were sold. But as time progresses, as though that portfolio still stays, with the widening of the MCLR, there have been some adjustments which has happened. The new portfolio that we have sold, that has been going at a lower spread, because of which there have been a hit into the P&L on a quarter-on-quarter basis. That is one particular reason. Second is there's a marginal increase if you see on our NPA in the gold loan business. With that marginal increase is resulting in some reversal of income, which is causing this marginal dip in the overall income for that standalone financials.
Okay. So if you could break down the non-controlling interest for our viewers, what is it and how does it impact the net profit?
So, non-controlling interest. So last year, ADIA came as taking 20% primary stake in our subsidiary IIFL Housing Finance. So with 20% stake taking in ADIA, so I would need to carve out 20% of my profit, which is the non-controlling profit, which goes towards that, which doesn't deserve to the parent company. So on a consolidated basis, when I account for my income, I will shave off the 20% of the income from the housing subsidiary and then aggregate the total PAT, which is causing this 20% dip in the PAT of the housing company when it comes and gets consolidated with the parent company.
Okay. Sir, if we look at the standalone numbers, the finance cost and the recognition of financial loss, that has spiked considerably. So what were the main reasons? These were the main reasons for the drawdown in the standalone numbers. So can you elaborate a little bit on that?
So finance costs, I can't take in isolation saying it's gone up by applying a percentage. Finance cost is depending on what kind of borrowing you have done across periods. So obviously, interest rates have moved up by around 250 basis points from an MCLR. From a repo perspective, MCLRs have gone up. But our cost of borrowing has not gone up beyond 25-30 basis points. The reason for the spike that you see is purely a base effect. The aggregate borrowing that we have done, or the average borrowing that we have done in the period last year to the period this year, has actually gone up. And that is causing an increase in the finance cost. It is not a question of finance cost going up that much. Finance cost would have gone up by around 30-40 basis points between the two periods. But beyond that, the larger impact is coming because of the base effect with the average borrowing going up with the increase in business and the business volumes going up as well.
Okay. Fair enough. So coming to the microfinance loans, in March quarter, there was a 25% growth. But if you look at the June quarter and September quarter, it has dipped to 5% and then 10% respectively. So is there any specific reason for the slowdown in microfinance loans this fiscal, or is it a conscious decision to grow slowly in that on that front?
It's a relative comparison, right? Otherwise, so if in an over within the Sehwag hits 6 in the next over, if he hits only 3, we see they have slowed down. So there's a euphoria in the microfinance space. Last quarter, which is the quarter where a lot of action happens, a lot of business volume picks up, a lot of momentum. Everything happens in the quarter 4. In most businesses. Related to that, subsequent quarters will always show a marginal dip or a slowdown, but otherwise there's no particular reason. The business is doing well. There's a lot of traction which is happening. We've expanded well in our branches, which is going to give us traction. So if you do a relative comparison purely from a peer perspective, you will notice that we are on the higher tier with regard to growth compared to the others as well. But just on a quarter-to-quarter comparison, it may not be the right comparison because quarter 4 works at a different level with regard to intensity, business volume, actions, and events.
Okay. So what is
growth of around 5% is fairly good. And we believe that there's enough potential in this space. The key is to have a good hold on your asset quality, and that's something we very closely watch.
Okay. So, what is your sense on the stress in unsecured loan book of IIFL Finance? Has there been any stress, or is it rising? Because Mr. Governor Shaktikanta Das also mentioned about it. There's very high stress in the personal loan segment, unsecured loans. So, is there any stress there?
So our unsecured portfolio is a fairly small portfolio. It aggregates to less than around 4-5% of our overall AUM, and we largely look into funding towards business loans and others as well. So that portfolio is being closely monitored, and we keep on doing amends with our underwriting practices, intensifying our collection engines as well to have a good hold on our asset quality there. And yes, what Mr. Das mentioned, that there could be pockets where there have been concerns emanating. But India has a wide market. As long as you are selectively making sure that you're operating in the right geographies and targeting the right customer base, you would always be better off. So we would be watchful in this space, and we would make sure that we have a good asset quality and good control on our book in this space, because these are largely unsecured.
Okay. Okay, so moving on to the fundraise, IIFL Finance raised up to 3,000 crore rupees via equity and convertible instruments. So how is it going to benefit the capital adequacy of IIFL Finance?
So, we have been growing at a fast pace. Our CAGR growth of the last 5 years around 23 to 25%. And for growth, you would need capital. And capital really helps you in driving your business more effectively. So the objective is to get the capital to support our growth. And we've been growing across all our businesses as well, including our subsidiaries, which from time to time need capital support as well. So the capital adequacy, of course, today stands at around 20%. With this capital raise, the standalone capital adequacy would inch up significantly higher, in the range of around 30+%. But beyond capital adequacy, the capital raise intention is, of course, to support our growth and support our businesses as we go further, because the opportunity in India from a credit growth perspective is immense.
Okay. So last question to you. What is the way ahead for IIFL Finance in terms of financial inclusion strategy, the technological advancements that you are planning ahead, and co-lending arrangements? Are we going to see anything there? And if you could give some targets, growth targets for FY24 and FY25.
Okay, so I'll take the last question first. From a growth target, while there could be individual businesses which might grow at different pace depending on the opportunity and the macroeconomic scenario in these products and these offerings, on an overall CAGR growth perspective, we'll look to grow at a CAGR of around 25% on an AUM basis. Given that we have expanded well and we have added a lot of branches pan India, that's on the growth over the last couple of years. Beyond that, it's a difficult thing to predict. With regard to co-lending arrangements, our co-lending book has been growing well. The share of off-book the share of co-lending in the off-book has gone up, and because of all the partnerships and tie-ups that we have done across product, more particularly in our home loan business, in our gold business, and also off late in our microfinance business as well. And there is enough opportunity here as well, because banks are keen to buy quality retail assets, and we have started early in this, and therefore we have hold a very good relationship with them. So this business will continue to do well and grow. Then, what was the next question? Sorry, I missed the orders there.
Is there any announcement on the technological front or financial? What is the financial inclusion strategy going forward?
So on the financial inclusions, our housing business is entirely affordable, and it also tags well with the private sector requirement of multiple regulators, whether it's the NHB or the RBI. So therefore, in that portfolio, there are a lot of multilateral investors who come and lend us to fulfill the objective and requirement of for example, green housing and some of the other social inclusion norms as well. So therefore, that's one business which will help the entire objective of financial inclusion. Microfinance for sure would meet the objective of financial inclusion as well, because there are a lot of new to credit customers, there are a lot of borrowers. The geographies itself which we have expanded is hugely underpenetrated from a credit growth, from a credit coverage perspective, which will automatically help us in transition and supporting the financial inclusion cause of the regulator and the broader requirements. So financial inclusion will play a very important critical role given the way we are operating. Now, lastly, if I talk about gold as well, we've expanded a lot in gold. And as you expand, you move into geographies which are unventured, which are more rural centric or semi-urban, where again the credit coverage has been relatively lower. And as you get in and tap in more customers, you automatically go and touch on new to credit customers and customers who have not availed finance in the past. So we believe that our role in financial inclusion, which keep on expanding and keep helping us meet the overall objective of the government.
Okay. Thank you so much for taking out time to be with us this morning, Mr. Jain. This was Mr. Kapish Jain, CFO of IIFL Finance, talking to us about the financials of the company and what is the way ahead. For more news, keep watching BQ Prime.